Welcome once again to Digital Training Hub. If this is your first time visiting the channel, hit the subscribe button and turn on notifications to receive alerts when new content is released. This is Lesson 4 of 7 on Entrepreneurship. Lesson 4. Entrepreneurial Awareness. Learning Outcome. Entrepreneurial Awareness. Learning Activities 1. Explore sole proprietorship, partnership, limited companies, and cooperatives, forms of businesses, as per business procedures and strategies. Special instructions. Give examples of sources of business finance. Learning Activities 2. Identify sources of business finance as per business procedures and strategies. Learning Activities 3. Identify factors for selecting the source of business finance as per business procedures and strategies. Learning Activities 4. Determine governing policies such as increasing scope for finance, promoting cooperation between entrepreneurs and the private sector, reducing the regulatory burden on entrepreneurs, and developing IT tools for entrepreneurs, on small-scale enterprises, SMEs, as per business procedures and strategies. Special instructions. Give examples of sources of business finance. Learning Activities 5. Explore problems of starting and operating SMEs as per business procedures and strategies. Introduction. This learning outcome aims at equipping trainers with knowledge on making awareness of entrepreneurship by identifying business forms, sources of finances, factors to consider when selecting them, governing policies among others, and problems that SMEs encounter. Definition of key terms. Forms of business. They are different business structures like sole proprietorships, partnerships, limited companies, and corporations among others. Governing policies. These are written regulations and laws laid by the government that businesses must comply with. Small-scale enterprises. This is a privately owned and operated business characterized by a small number of employees, requires small capital to start, etc. A business is regarded as small depending on the regulations of a country. Forms of businesses are explored as per business procedures and strategies. Sole proprietorship. This is a form of business that is owned by one person. Advantages of sole proprietorship. It needs no charter to establish it. There are few castes that are related to its establishment. All the profits go to the owner of the business without sharing with anyone. Easier to raise startup capital that is from the owner's savings. You are your own boss. Flexible to start your business at any location, any time of the day. Motivation because you get all the profits. One has personal contact with customers and hence can be able to respond to their requests. Disadvantages. Sole proprietorship. In case of losses, the sole proprietor bears all the losses by himself, herself. The sole proprietor will have to work very hard to sustain the business, hence leaving less time for leisure, recreation. A sole proprietor has an unlimited liability that as a creditor with a claim against a sole proprietor would normally have a right against all of his, her assets whether business or personal. Poor and uninformed decisions made by the owner of the business may lead to the collapse of the business completely. One has nobody to discuss business problems with. One has limited finance or capital, hence the business will remain small. 2.0 Partnership. It is a relationship that exists between two or more persons carrying on a business common with a view to making a profit. It is an agreement when two or more persons combine their resources in a business with a view of making a profit. When two or more persons wish to form a partnership, then it is recommended that they agree on the terms upon which to form a partnership. This is done in writing signed off as agreed by all the partners and therefore it becomes a partnership deed or agreement. Contents of the partnership agreement. Name and address of the firm and the partners. Capital is to be contributed by each partner. The profit-sharing ratios are expressed as a fraction or percentage. Salaries are to be paid to the partners. Any interest to be charged on drawings by the partners. Interests are to be given to partners on their capital balances. Procedures to be taken on retirement or admission of a new partner. Membership. It has a minimum membership of 2, and a maximum of 50, except for professional firms, e.g. lawyers, doctors whose maximum membership is 20. Types of partnerships. General partnership. In this, all the members share the management of the business and each is personally liable for all the debts and obligations of the business. Each partner is responsible for and must assume the consequences of the actions of the partner. Limited partnership. Some members are a general member who controls and manages the business and may be entitled to a greater share of profits. A legal document setting out specific requirements must be drawn up for a limited partnership. Advantages of partnerships. Additional capital can be raised in case a sole trader is not able to raise sufficient capital. There is increased expertise in certain areas of business because of the existence of many partners who are skilled differently. Informed decisions and judgments can be made since the partners are involved in the decision-making process. It is a tax pass-through entity. Disadvantages of partnerships. Wastage of time in decision-making since all the partners must be consulted, which takes time. All partners are liable to payment of all the losses that accrue in the business. Some members have limited liability while others have unlimited liability. Can be dissolved at any time either due to the exit or death of a partner. If one partner is inefficient or dishonest, everybody loses. Limited companies. It is a type of business structure that has been incorporated at the company's house as a legal person. It is completely separate from its owners. It can enter into contracts using its own name and it's responsible for its own actions, finances, and liabilities. Characteristics of a limited company. Separate legal existence. It is its own separate legal person from the owners of the business. Limited liability. Shareholders are legally responsible for the debts of the company only to the extent of the nominal value of their shares. Flexibility in taxation. Members of the corporation have the ability to choose the form of taxation that makes the most sense for the business, i.e., can choose to be taxed as a subchapter corporation or subchapter corporation. Simplicity in operation does not require having shareholders' meetings, appointing the board of directors to run the company, i.e., simplicity in operation while the corporation with no shareholders' meetings. Therefore there is no attendant preparation of filing of minutes of the meetings, i.e., simplicity in the documentation. Advantages of a limited company. Protection of the company's name. It is an entity separate from its owners, and its own rights, responsibilities, and liabilities. Can file a lawsuit or can be sued in its own name. A limited company is tax efficient, i.e., tax flexibility. Personal liability is limited. Debts are only to the extent of the nominal value of their shares. Perpetual existence. Owners of the entity can change without triggering the dissolution of the company unless stated otherwise in the articles of the organization. A member's death, retirement, withdrawal, etc. doesn't mean that the company must cease to operate. Less paperwork. Having limited company operating agreements to create rules that govern your business, hence less paperwork for compliance with the rules of your state. The high status of the company will attract investors and customers. Disadvantages of a limited company. Required to pay a registration fee to the company's house to incorporate, i.e., legal formalities. The company name is subject to certain restrictions. More complex and time-consuming accounting requirements. Strict procedures for withholding money from the business. Owners lose control when the original owners hold less than 51% of shares. Selling of shares is expensive because of the commission paid to banks to aid in selling shares and the costs of printing the prospectus. Cooperatives. It is a group of individuals who have specific common needs. Its purpose is to improve the economic status of the members. Advantages of cooperatives. Tax advantage. Exempted from income tax and surcharge on its earnings up to a certain limit. It is also exempted from stamp duty and registration fees. Democratic management. Managing committee elected by members on the basis of one member and one vote irrespective of the number of shares held. State assistance. This is done by the government as they see cooperatives as an effective socio-economic instrument of change and therefore offered grants, loans, and financial assistance to make their work more effective. Open membership. Anyone can join irrespective of their color, age, religion, or economic status, and there is no limit on the maximum number of members. Limited liability. The liability is reduced to the extent of their capital in cooperative societies. Social service. The basic philosophy of cooperatives is self-help and mutual help. Thus, cooperation fosters fellow feelings among their members and inculcates moral values in them for a better living. Disadvantages of cooperatives. Lack of mutual interest. All members are not imbued with a spirit of cooperation and such absence breeds mutual rivalries among its members. Corruption. In a way, lack of profit motive breeds fraud and corruption in management. This is reflected in the misappropriation of funds by the officials for their personal gains. There is slow decision-making since all members of the managing committee have to be consulted. Less capital incentives which do not appeal to long-term investors. Sources of business finance are identified as per business procedures and strategies. Owner's capital. It is the only source of capital for the sole trader starting a business. This type of capital when invested is often quickly turned into long-term fixed assets that cannot be readily converted into cash. Plowed back profit. It is the most basic source of funds for a company. Firms profit by selling a product for more than it cost to produce. Borrowings. Like individuals, companies can borrow money. This is done privately through bank loans or publicly through a debt issue. Overdraft. This is a form of a loan from a bank. A business becomes overdrawn when it withdraws more money than is available in the account. This leaves a negative balance on the account. It is often a cheaper way of raising capital. Leasing. A business has the use of an asset but pays a monthly fee for its use and will never own it. A business looking to purchase equipment may decide to lease if it wishes to improve its immediate cash flow. Issue of shares. A company can generate money by selling part of itself in the form of shares to investors, which are known as equity funding. Factors to consider in selecting the source of finance of the business. Cost of capital. Every source of capital comes with a cost. The cost of getting capital should not be extremely high. Most businesspeople prefer debt to equity because its cost is low due to the interest tax shield. They are not taxed, which lowers the cost of capital. Risk of the business. When choosing a source of finance, one should consider how much risk the business will face when they acquire that source of capital. That source of capital should not put the business at very high risk. Control of the business. Owners of the business who do not want to lose control of the business would rather finance the business using debt rather than equity, which will dilute the ownership of the business. Purpose of the borrowing. If the reason for acquiring the source of finance is to purchase non-current assets, the business would rather use long-term sources of finance to fund the acquisition of the non-current asset. The size, status, and ability of the business to borrow. If the business has assets that it can use as collateral, it can consider borrowing loans from a financial institution. Governing policies on small-scale enterprises, SMEs, are determined as per business procedures and strategies. All the state governments provide technical and other support services to businesses through their directorates of industries. The government accords the highest preference for the development of small-scale enterprises by forming and implementing suitable policies and promotional schemes. Thus, government plays a supportive role in developing entrepreneurs. The following are common areas of support: development and management of industrial estates, suspension, deferment of sales tax, power subsidies, capital investment subsidies for new units set up in a particular area, seed capital, margin money assistance scheme, priority in allotment of power connection, water connection, consultancy and technical support. Problems of starting and operating SMEs are explored as per business procedures and strategies. Financial constraints. Finance has made it difficult to progress and provide quality services. Financial institutions find it hard to consider lending loans to them as they have few assets that could be used as collateral. Competition. The low comparative advantage in production of certain goods as compared to our trading partners. This has restricted entry to the businesses as production costs may be higher relative to the cheap imported goods. Lack of advanced technology. Technology is fundamental and a prerequisite to higher output levels and reduced production costs. This has made them not to flourish and participate in regional trading due to low quality output because of the use of obsolete technology. Insecurity. Security poses a great challenge to small-scale business owners in Kenya. Many of the businesses suffer loss due to theft or thugs invasion who steal from them, which lead to loss in terms of destruction. Hawkers pose a challenge to small-scale businesses because they sell cheaper and their goods are of high quality. Competing with hawkers on prices is debatable. Since hawkers move from one place to another bargaining on price. Since most of them don't consider a lot of profit but sale of goods. Conclusion: this learning outcome was based on exploring the various forms of business, identifying sources of business finance, critical factors to consider while selecting business finance source, Determine governing policies for small-scale enterprises and explore challenges for starting and operating SSEs. Further reading https://www.google.com/create+entrepreneurial+awareness and create+entrepreneurial+awareness. We can come to the end of the lesson. Links have been provided for further reading. Thank you for watching and listening to this lesson. See you in the next video. If this was your first time, remember to hit the subscribe button and turn on notifications to receive alerts when new content is released.